Francis Hunt, CMT from themarketsniper.com, is back once again today to talk about precious metals and the price action that we may see going on into 2022. This and more on this week's episode of Metal Money. I'm your host, Patrick Vieira. Francis Hunt, welcome back to Metal Money. How are you doing?
Hey, great to be back with you, Patrick. Thanks very much for having me.
Glad to have you back on. You know, Francis, last time we spoke back on September 21st, you said gold will go down again, and the key level is 1750. You were on target with that call where gold stayed only a few days under 1750 and came straight back up. Not really touching it ever since. Great call. Why is 1750 a key level on the downside or support level for gold?
It is a key level. In fact, I've got a couple of levels. If I were to include 1750, I'd say, well, we've got 1680, which was the one that was repeatedly visited. We started straight up with the charts, Patrick, with gold up here. So I'll just highlight, let me make that orange so everyone can see it so it stands off. We've got the 1680, which has been tested actually 3 times. There was a small double bottom in there that was test. So that's sort of a very low level line. We're doing what I sometimes refer to as cheekily as iceberging, where the water line of 1800, 1750 kind of lies over here. And you're having just small elements of period where we can have hang time above. And these have been all quite volatile. So, you know, the 1750, the 1800, we're sitting there in its spike above, and then we can't seem to retain it. And here's a concern. What I'm actually showing you on the chart is a new forecast, which will build on your question, around the 1750. I'm actually quite concerned for precious metals short term. I think it's going to be the opportunity of a lifetime long term. So if you wanted to just say, what's your key message for all our bullion guys that are watching this? Have your powder dry. You're going to get your final Black Friday sale, and it's going to probably come in between now and the end of Q1. I fear March period a little bit. I'm getting a lot of tingly feelings around March. We might be in a bit of a benign state now, so we'll have a little bit off, a little bit of bounce. We might retest the 1800 again, churn around, come down. This particular dashed red line that I've done in bold just in time for this presentation is a concern for me. We call it a basing ascending grind line. Basically, we keep coming and we're testing. We also had a support, which was the 1680. My concern is that we're going to have some form of deflationary scare that's going to see us potentially get back to 15. I've got a target guesstimated. The structure pattern isn't yet finished for us, but around 1500. That could actually see you trade a 1480, a 1497, or a 1450 or something in an extreme moment. I have a feeling that we're going to get a deflationary event. I know you've got some questions for me around, I don't want to get too far into them because you're going to bring these up in the natural flow, but around Powell's taper tantrum with regards to transitory as a word being put one side. And my concerns here is that the Eurozone is very much in a requirement of stimulus. You've got Turkey, of course, falling apart on the Turkish lira. That was an FX trade. By the way, we had community members trading gold versus the TRY. Unbelievable bullish structure setup that they've done exceedingly well with during that period. But that point aside, a lot of European banks lent that money to Turkey, a lot of it. And you're talking about Spain, Italy, Portugal, France. This is a huge problem. Turkey being a problem for Europe is a huge problem for their financial system. So we've absolutely storing up all sorts of potential downside risk that will be highly deflationary of nature. And in that environment, you typically tend to find that gold isn't served well, and the dollar, if I look at the bond markets as well, and I don't want to talk about too many other metal markets apart from precious metals. This is a precious metals market channel, but I do have to say the FX is the big market. You have problems in FX emergings. You're getting flight to inverted commas safety. We're seeing the bonds, the long-term bonds getting a bid. Interest rates should be going up, yet they are getting bid up, the capital value of them, and that's downward pressure on the yields because there's more fear and there's a deflationary next stage a spiller event. I will also point out that March of 22, or the lead up to that quarter one period, is the 2-year anniversary of the original pandemic of 19, actually 20, was when we went into lockdown, although it probably started December 19. Who knows when the rumblings first started. But the lockdown and all the drama and the big blowout, that saw the huge spill in silver that took you got an opportunity to buy, I think it was $14. We'll confirm that now. And in gold's case, you saw us drop to 14.20-ish during that period. That was the first dip. Then there was the shock and horror dip, and then we were back. That's what eventually gave us so much credence around the 1680 level as such a critical level, because we just floated back up because of all the printing in that stage. That's made this a very strong support now, what previously was a resistance, because you couldn't take it at that point. You couldn't take it pre-pandemic. Then you had the pandemic spill. You couldn't take it. And then eventually we broke above it. That's why now 1680 is such a key level. And I think we might rally and churn. You don't have to, I wouldn't trade in and out of your physical holdings at all. But if you are a trader on the paper markets, it's not a panic sell now. I think you actually get a little rally and we take 1800 one more time, because we've iceberg just above it if it's a waterline. You were asking about the 1750. I think even now, I'd almost go the 1800 is psychologically probably even bigger now. You might iceberg a little bit more again, but at some point we spill on a fear. And I'm seeing this both in silver and gold. We'll pivot to the gold market. I've taken a lot of time just answering your one question, but that's what I'm seeing. I'm seeing a bit of fear, and I'm pointing to FX emergings, indebted nations, of which Turkish lira. Turkey is the probably 18 million, massive economy on the corner of Europe, absolutely lost control over its currency. And there's a flight to safety in fear, plus divergence in the euro. So we've made a massive call on the euro, Swiss franc, and the dollar index getting strong. The god market of fiat money is the dollar. And unfortunately, when that gets a bid, it's not supportive for anti-fiats, which will be not only bad news for gold and silver people, but would see continued pressure on the inflationary oil. Inflation is I call it oil is the Rockefeller tax on all activity, because it's in everything, packaging, delivery, you name it. So that'll see downward pressure. So the Fed will win back credence, because they look like they were behind the curve on the whole inflation narrative. That divergence with Europe is going to see major sell-off in the euro. So the flight of money into the dollar is going to be the anti-fiats will suffer under those circumstances. Gold, silver, Bitcoin, and oil might not be over its sell-off, or might churn and stay down for a while.
Okay, and Francis, what number do you see at silver when all this happens? Because right now silver seems to be range bound between 22 and 28. But when you see this happening for gold, what do you see happening for silver at that time?
Yeah, a good question indeed. So I've been tidying up my silver chart a little bit, and there's an uncomfortable. We looked at this. We looked at a lot of the structure when this was first being built. This pattern structure, we saw it break here. We warned that there will be down legs, all these little structures. These were all small time frame selling points that we highlighted here. And my concern now is what I've just said to you about 1680 for gold, is you're starting to have repeated taps on the trap door of the $22 mark. This was a close to, that was a close to, maybe touch, that was a clear break, and here's another touch over here. So let me just draw those without the other pink crosses again. I'll put them in again there. You had two clear touches there. You had a reach for it. You had a touch. You had a breach and rally, and you've had a touch. So the $22 mark is getting lent on now. So given this pivot. And some people might say, well, your views changed, you were bullish. Well, I was bullish after sell-offs. I'm becoming more concerned generally about what I'm seeing in metals, especially since the central bank pivot has taken place. For me over here, this is a concerning structure. We did trade higher. This was your Wall Street bets high, you might recall, when that went peak mania. And that was that pop out the top. That unfortunately gives you a higher high. I've always felt a little bit uncomfortable with that one. So you could in fact have a left shoulder. You could in fact have a complex head. I call it complex because you kind of, it's not a simple path. You know, it's almost double top effect there. And then you've been in the staircase down where you leant really hard and you stayed for a long time down. The concern here was there was an extended period here. We're getting heavier on the floor and we're rallying less. This was an electric fence. You pumped off it, you pushed off it, you pushed off it again here. It literally is candle wicks. I might just adjust the time frame. We don't need, there was your low, by the way, I was talking about. It was 11. I think I said 14. I apologize, I'm corrected. So the low that we had on the COVID was very, very good value buy. And I think you're going to get, those who missed that event are about to get another chance for their Black Friday sale. So if we just highlight that, and I'll draw this, I haven't yet done this for you, and I'll show people just quickly how you do a head and shoulder for silver. If we are to be wrong about, I would be as the happiest man in the world, but I think you're going to get another chance to buy it silver exceedingly well. And again, we clone that. So what are we doing? We're running the high from around about 30. We had a spike high. Now, I don't think necessarily that it has to perform to target. You can sometimes get a breakdown in a head and shoulder and not actually get the price. But I remember when I did oil, when oil traded below 25, when 25 was the lows of the 2008 crash. And I said, man, I would never have guessed it would have gone down that far. To many people looking right now, a $13.40 is like, I can't see that happening. I would love to be wrong, and I hope it isn't happening. There's a threat of a head and shoulder. And some of you will be saying, but we've never been more inflationary. How can you even dare come out and throw out a $9 collapse in silver market? Which represents, as I say, about 40%. And you imagine those Bitcoin kiddies, how they're going to do on a much higher beta asset. It's going to be uncomfortable. Unfortunately, we're looking at predicting a future event that is pretty cataclysmic. And we did do that when we called single-digit oil. Remember, you hadn't traded in single digits for 35 years. There was a more idiotic sounding prediction when it was $67. And we said there's a disproportionate probability that events are coming that are going to bring us down. And then everyone said, wow, you're an absolute loon. I hope to be wrong. I'm just saying to you, there's unfortunate structure. There's an inverted HVF, as we call it, on gold, which we highlighted over here. And that could see a break into the 1400s. And the disproportionate beta, which in percentage represents about 300. If let's say you went 1480, it's about $300 on gold. That's a massive spill. But in a percentage terms, silver would be the bargain buy if it was to make a head and shoulder down here. By the way, and I'm jumping around a little bit, just because you have a head and shoulders doesn't mean they actually have to break. There's no contractual agreement in technical analysis. It could turn into a ledge. The concern I have is we've just got heavier and heavier, and the environment with this differing interest rate opinion is leading to this greater weight. There's a sense of lean here. We can't get away from 22. In truth, we've set up a lot of possible structures that should have gone upside, and the market hasn't had the follow through. And the momentum on the downside with regards has actually got more vicious. The gradient to getting up is like that, and the elevator down is far more brutal. It's free fall. There's just a real absence of bid there in the paper markets, as I'll continue to ascertain. And I absolutely agree with that amazing vid that you have with the Gatter guys. Absolutely. I think it's Chris Powell. Makes some absolutely valid points. They're going to seize on this opportunity if there's another fear moment coming for us, scariant type scenario. I don't know what that will mean. The metals could be providing another major buy time.
Okay, so major buy time perhaps coming somewhere around Q2 of 2022 or so, but after that, you're expecting a pretty prominent upside.
Well, the other key point about this is I've been doing some sort of spitballing speculation, and this is entirely speculation. If this isn't speculation of a technical analysis variety, let me talk to you about how does this play out. I'm thinking, well, what sort of circumstances are this? When I listen to the Gatter guys like Chris on that excellent interview on your channel, by the way, everyone should watch that. What a knowledgeable guy. And how, the Bank of England and various actors in this have refused to answer certain questions. As I was mentioning it to you, it's kind of a bit like the vaccination. Those that, if you ask anyone if they've been vaccinated and have, they'll say yes. And anyone who says none of your business, it means no. In the same way, when these central bankers are not wanting to answer a question, it's safe to assume that they are in fact acting out. So for me, the gold and silver market has to be captured for the debt system to have continued to play in this sense. So if you take that as a given assumption, the problem is when reset occurs and there is an event, I don't think these pandemic events end until digital money and passports are out. And that's going to be following a financial crisis of debt and currency led. And I pointed to the divergence in the Euro USD. If I may take you slightly out of precious metals, but it's very clearly bearing, I will highlight that in actual fact, and everyone thinks the dollar must die for metals to win. And I just want to challenge folks on that thinking. The gold and silver wins regardless. And in actual fact, in the scale of dominoes, biggest falls last and falls hardest, in my overall view. So you don't have to, in the short term rate of events, we're actually seeing a very strong dollar index. Now, it might rest a little bit now. We've got a little bit of shooting stars and upper wick action. Could come down. It could even come all the way and revisit this neckline. But the dollar index is going up, which is almost more a harbinger of euro problems than dollar to dollar. It's dollar relative strength compared to something else even more compromised at this point in time. And if I take you out a little further on the time curve to the monthly, and I'll go to the end of day here. And this is one of my favorite charts that I'm showing a lot of people right now, is given the scale of debt. So this is the dollar index chart. Given the scale of debt in the major economies, the fact that most of that debt has been issued in dollars actually sees, as those emerging currencies fail, for which Turkey is the one of the first leaders, the one of the first shoes to drop, it's because of their dollar indebtedness and their lack of ability to print dollars. So they are dollar hungry. And outside of America, the Triffin's dilemma is that the currency of the world nation runs deficits and exports dollars. So what you're actually having is, despite the printing and the scale, because the debt is so large that there's actually a shortage of dollars needed in the external nations that are borrowed in dollars, because an interest system always requires more dollars to pay the interest back, not just the capital. So if I borrow $1,000 from you, but I'm paying 10% interest, I actually need 1,100. And the longer I'm holding that debt, the bigger that number gets. So there's an implied compounding demand for dollars that is parabolic on compounded interest. So the way the system, the way gold and silver wins, will actually be first facing a headwind of dollar strength as other currencies fail. Bear in mind, gold has done brilliantly against the Turkish lira, and it's done brilliantly against other FX emergings, and eventually it wins, doing brilliantly against all pairs, including the dollar. And that key flippening moment is when you get the gold silver strength and the anti-fiat category strength as a whole into dollar strength, but it's just stronger still. As everybody then starts to question fiat entirely. However, the bid on the bonds shows that fear, Pavlovian responses still hold. You ring the bell, the dog salivates, scared money buys US debt. And that's still the case, but that link is getting more tenuous and will break. So people need to have a slightly different model. I know when people talk of a character like Peter Schiff, everything has got to be dollar death. It comes in the end. It's not the first. Remember, the FX emergings are I call them the tramps outside the village walls, the castle's walls. They've got to fall first, unfortunately. And then as you go deeper and there's more walls in the village, the high priest and the king lives behind 3 or 4 walls and is in the middle and has the nicest conditions. So as you get into the more serious currencies, and as the smaller ones die, they first rush into the safe haven, perceived, inverted commas, dollar. So the dollar actually gets a surge of strength because most people run from currency to currency. Only when they break the Pavlovian thinking and say, hang on, this is going to follow through all currencies, it's time to escape into other asset categories. So I don't know if that helps people. Just I'd like to be not only a technical analyst that looks at macro charts, but the futurist of best understanding on how we fail. So don't pray necessarily for dollar weakness. Yes, it typically up until now has been very supportive for the precious metal category. But I think overall what we're seeing is the failure of Eurozone currency, and some of that money won't go into dollars. Some of it will find its way into gold, silver, and even some crypto projects. But initially, when the dollar is strong and dominant, all anti-fiat suffer. It's a headwind. So I don't know if that helps, just pivoting to that chart and my expectations. I'll just allow people to absorb that for a while. We're actually making calls here. This won't happen by quarter one. I think we make 99 on the dollar index, and then we'll have some softening. Then we'll set up, and then we'll have a major surge in dollar. And that's pointing to the divergence that people are not noticing. And this is your headline on The Economist, Time magazine for 2022 and 2023. The divergence of the economic zones. And this is going to cause too much dollar strength and FX emerging currency failure. And that's how you lead into a Bretton Woods system. And you may not get very much time trading freely for gold in this environment. They may go straight to a revaluation, with some of it being with many of the central bank digital tokens, which is where I believe they want to take us, being held. And there's nation states that have a large amount of gold, have a sort of implied greater tethering relevance because of that. And they might just do an entire revaluation of gold. You might not ever see it trade honestly at its true reflected price. We could just transition. And we were chatting, but I mean, just imagine, to throw a blue sky thing out. And this is where my spitballing analysis comes in. Just imagine post a reset in a central bank digital token. They just revalue gold at I'll throw a ridiculous number out just to expand people's minds of what's possible. 100,000 and silver $10,000. And they say that's it. Because they might want to future-proof their new system against further inflationary policies. Whatever system they introduce, government is going to want the right to run an inflationary shell game of proliferation of money. That is their axis of control. Reducing the money supply is never in the interest. Although they do create deflationary events when they want to let out a bit of steam and shake out leveraged traders. Retailers usually pay that as a tax. And those things can happen. So in all of those events, one of my concerns for us all will be we may be obliged to register as holders of precious metals. I think they're going to first want a registering list to know, and they might go to all bullion vault dealers and by a law and diktats force them to disclose everyone who's purchased, and then you'll be on a list. And then later they might do one of two things: pass on a huge capital gains tax when they do a revaluation like they did on the $35 from 20, only it'll be on a much bigger scale, in my opinion, or attempt confiscation, which is the real black-pilled option on the basis of, that would be global communism, in essence. So on that cheery note, I don't know if I've done answered your question in full, but I've taken you on a journey there of possible outcomes. But despite that, you've got to buy the insurance, because I'd much rather pay a capital gains tax on something that gets revalued and be one of the few people that gets truly saved when we go through this key transition. It's almost like the Shawshank Redemption, if you can remember the movie. And forgive my language here, but you're going to have to crawl through the shit pipe in terms of getting through this transition period to get that freedom on the other side, where he stands in the river in the rain with his hands raised like this, and he's finally free from his travesty. But he had the final journey. And I think we're coming to that point where, for the freedom that we aim for on the other side, hopefully, politics dependent, there's going to be a heck of a pipe to crawl through to get there. So I don't know if that gives a little bit of color to looking forward into the future and how I think they will play the game, the control structures of the world, government.
Okay. Francis Hunt from themarketsniper.com. You've painted us a pretty colorful picture here. We appreciate that, and we hope to get you on again soon.
Great talking with you, and may all your listeners and everyone have an awesome new year. Only other point I'd say is get out, stay healthy, exercise, get some sun, switch the TV off a little bit, stay subscribed to your channel for sure, and sit it out and play the long game. Don't be shaken out. So avoid leverage trading at these times. There's a lot of spookiness out there. I'm on themarketsniper.com if people want to engage with us with regards to our positioning in this game, the Great Reset game.
All right, Francis Hunt, we thank you once again and look forward to doing this again soon.
Thank you. Bye for now.
There you go, Francis Hunt from themarketsniper.com, sharing his views on the metal road ahead. As always, please leave your thoughts in the comment section below, and remember to keep it liquid, keep it real, and I'll see you on the next episode of Metal Money.